we're going to have Kathy Hipple, who is an expert at the Institute for Energy Economics and Financial Analysis, and a huge wealth of information that has been used by campaigners to support their work around the country. And she's going to talk about how why the already strong financial case for divestment has become even stronger. Kathy, over to you.
Thank you, everyone, for participating. So I'm here to report that the very already strong case for fossil fuel divestment was strong, but it has grown even stronger. It has grown even stronger in the past month, as you might imagine. So my name is Kathy Hipple. I'm a financial analyst at the Institute for Energy Economics and Financial Analysis. We do reports, it's a team of global experts. We do reports in the United States, Asia, Australia, and South America, South Africa, Europe, and we have a very global perspective. I personally have a background on both Wall Street and Main Street, and I work with a team of experts exploring the energy transition, which we believe is well underway. The case for divestment is compelling. A quick overview, and then I'll get into it, is the production of oil and gas is booming. It is still booming. You would think that it would have stopped by now, but that has not been the case. It's been fracking, as you might imagine, which we call hydraulic fracturing, and horizontal wells have allowed this to happen, and that is what has led this boom. But financially, and my analysis will be all of a financial analysis. There are experts who do the environmental analysis and other reasons, but I focus, and the group at IEFA focuses on financial analysis. Financially, the oil and gas sector has been a bust. Oil and gas companies have underperformed the market for a decade. This is not new. The energy sector is shrinking. And today, the oil and gas companies are in extremis. They are in terrible financial shape. So you might not be surprised to think that funds without fossil fuels have outperformed the broader market. You've been better off if your portfolio has not held fossil fuels. Okay, so in March, for those of you who are just emerging from under a rock, the world changed. We became aware that this economic downturn caused by the COVID-19 would lead to huge ramifications in demand for oil and gas. We also had an oil price war between Russia and Saudi Arabia. And this has been called unprecedented. I did a wordle of some headlines for the first 3 months of the year. It's been a disaster for that industry. The industry would like us to believe that this was a black swan event. No one could have predicted it. It came from nowhere. Even the smartest people in the room could never have figured this out. But I'm here to report that this decline began a long time ago. This is not a black swan event. What has happened in the last month or two has accelerated a trend that has been in existence for a full decade, if not longer. In fact, the energy sector, which does not include renewable energy, these are only oil and gas stocks, it's been the worst performing sector over the last decade. In fact, if you can see this line, energy is the red line on the bottom. It has only returned 6% in 10 years compared to IT, which has been up over 300%, and the broader market, the Standard & Poor 500, which has been up 190%. So that's over 10 years. Let's just look at what's happened over this year. If you look at this blue line at the very bottom, that is the energy sector once again. It's down an astonishing 44% this year alone, and these numbers are through today. Every other sector has performed better than the fossil fuel sector. So one other point to know is that the energy sector retains a lot of political power, but its financial power has really waned. If you look back in December of 1980, oil and gas stocks represented 29% of the market. They now represent 10% of that number. They represent only 2.65% of the broader market, which, as you can see, is a long-term 40-year decline. The oil and gas stocks no longer drive the world economy, and the world economy can grow even if they don't grow on a relative basis. So no surprise here, energy is only 2.6%. No surprise to most of you, it's been IT, healthcare, financials, communication that has grown much faster and now commands a much bigger percentage of the S&P 500. Maybe a different way to look at this is back in 1980, 7 of the top 10 companies in the world were oil and gas companies. This was, of course, before Exxon and Mobil merged. And there were companies like Schlumberger that were one of the 5th biggest company in the world. It's hard to believe. By 2018, only ExxonMobil was one of the top 10. And last year, ExxonMobil in September of 2019 fell out of the top 10. So the top 10 companies no longer are oil and gas companies. And there are in fact only 3 oil and gas companies still in the top 100 S&P 500 companies. So we have a completely different world than we had in 1980. Now, frackers, we call these shale producers or exploration and production companies, have performed especially terribly. And that has what has led the production boom in both oil and gas. And it's the US, where most of the fracking has occurred, that has really led this incredible production, which has led to a worldwide glut. So it's really happened before the oil price war between Saudi and Russia. This has been a decade-long trend where these fracking-focused companies have been cash flow negative. The bottom line is the business case for fracking has never been proved. Year after year, from 2010 through last year, the companies in aggregate have been negative cash flow. So simply put, the business case for frackers has never been proven. So what happens when you have negative cash flow year after year? No surprise, you end up with a lot of bankruptcies. And over the last few years, there have been more than 200 bankruptcy filings, and over 128 billion in debt has had to be restructured. And last year, 2019, the number of bankruptcies in upstream oil and gas companies doubled. And that was just the beginning, because imagine what's going to happen this year in 2020. So no surprise, if you look at that and you say, well, things are so bad with oil and gas companies, how would funds without fossil fuels have performed compared to funds with fossil fuels? And if you look at the S&P 500, an ETF that tracks that, SPY, versus an ETF that tracks the Standard & Poor's 500 but does not include fossil fuel stocks, you can see over the last 5 years, the funds without fossil fuels have substantially, almost 4 full percentage points, 400 basis points nearly, have outperformed over 5 years. That is a substantial financial outperformance. So anybody who is managing money has to be aware of the substantial outperformance a fund would have without fossil fuels based on the past. So as we all know in the financial world, finance is all about the future. So I will leave you with just one idea, is what does the future hold? We don't know. I mean, obviously, if we knew this for sure, who knows? But what I will say is oil and gas companies face an existential crisis. The decline, they are in mature that's a mature industry, it's a secular decline, not a cyclical decline. We don't see them bouncing back. Maybe if you're an oil trader, the prices will go negative and then they'll go positive, but over a long-term trend, they are in decline. So there's a quote I love, which is from an English firm, Redburn. It's an equity research firm. And they wrote a paper last year called Lost in Transition, Oil Majors Lost in Transition. And they had a quote which was, recent precedent shows that when sectors face existential risks, historical multiples provide no floor for share prices. So in plain American English, it means there is no bottom for these companies' stock prices. So we know that this industry is in decline and it's an existential crisis. And what this quote is saying is, we don't know where the bottom is. There is no bottom for this. So I will conclude saying the case for divestment has grown even stronger over the past 2 months.
Thanks, Kathy. Thank you so much for that. What's been really amazing to watch for our movement is the fact that the moral case for divestment, which was always foolproof, has now been buttressed by the financial and legal case. These trustees are derogating their legal duty to protect pensioners by holding on to these loser fossil fuel stocks. So the question really becomes, why are they still holding on? And I think part of the reason big institutional investors like pensions, Tom DiNapoli in New York and Simpson in California are holding on is because of the hefty oil price dividend that they're used to getting. But as your work at IEFA has shown, those dividends are soon to be on the chopping block. They're a house of cards that has been held up by borrowing and asset sales, and it's not a sustainable solution. So thank you so much for all the work that you're doing